Welcome to EAGTAX and our tax advent calendar, where we will be looking at tax tips and explanations in the lead up to Christmas. For day 14, we will look at claiming a tax relief which prevents a capital gains tax liability arising when giving away qualifying assets. There are two key qualifying sets of assets: qualifying business assets and assets placed into certain trusts. Qualifying business assets include assets used in your trading business, assets used by your personal trading company, unlisted shares and securities in a trading company, or if listed, qualifies as your personal company, and qualifying agricultural property. The claim must be made by both donor and recipient unless settling into trust, and then the donor's agreement is just necessary. The effect of this relief is to pass the donor's tax cost onto the recipient. Where some consideration is received, rather than it being an outright gift, this relief is still available, but it will restrict the amount permitted to be held over. For single business assets, periods of non-business use will restrict the amount of gain which can be held over. Partial business use of a building can also restrict relief. Where a donor gives shares in a personal company or has held at least 25% of the voting rights in the company within the previous 12 months, the amount of gain which can be held over is restricted where the company holds non-business assets. If the recipient becomes non-resident within 6 years of the end of the tax year of transfer, the capital gain held over will crystallise unless an election is made in relation to UK land. This crystallisation event does not apply to those who move overseas for employment and become UK resident within 3 years, having not sold the asset. The market valuation on transfer can also be deferred if both parties agree. However, when you gift an asset, this value will remain in your estate for inheritance tax purposes for at least 7 years. Therefore, a CGT and IHT valuation might be useful. Where IHT is suffered by an individual or trustee on an elected asset, this charge is generally deductible against sale proceeds so as not to suffer double taxation. The IHT cannot create a capital loss, however. Trustees expecting to be able to claim private residence relief on the asset transferred will need to speak with the settlor regarding gift relief. Gift relief is also not available for settlor interested trusts. We hope you found this useful. Please take a look at our website for more information and contact details at eagtax.co.uk.